share sale or trade and asset sale, share purchase or trade and asset purchase. In this video, we'll outline and we'll look at in a bit more detail the implications surrounding whether a vendor or purchaser would prefer the sale or purchase of shares of a company or the sale or purchase of trade and assets of a company. And we'll also discuss the tax implications regarding each scenario. Before we go on, don't forget to like, comment, share and subscribe to our channel. This video is brought to you by ASWATAX, Chartered Tax Advisors. My name is Omar Aswat. Now, a purchasing company can acquire the shares or the trade and assets of a company. So that's the first thing. And then obviously the same impact will be on the seller. The seller would either sell the shares or sell the trade and assets. And broadly speaking, and especially from a tax position, there'd usually be a conflict and negotiations and discussions will need to take place. Why? Because broadly speaking, again, each company's circumstance and position needs to be looked at in more detail, but a seller would prefer to sell the shares of a company, whereas the purchaser would prefer to purchase the trade and assets of a company. And the reason for the seller, the vendor, to sell the shares is because there are valuable tax reliefs available. For example, the disposal of shares would give rise to a capital gain on the disposal of shares for the individual shareholders, and then potential business asset disposal relief up to a value of £1 million will be available. So it'll give you the 10% tax rate, 10% CGT rate, rather than if they sold the trade and assets. Effectively, what would happen in that scenario is the underlying properties and assets and trade would be sold within the company, and the company would have to pay corporation tax at 19% currently. So that's tax one, you could say. And then the cash that's been paid by the purchaser would still be sitting in the company, separate legal entity to the shareholders. So now for the shareholders to extract the funds into their personal hands, there's a double taxation, right? Because now the extraction of funds will have to be by way of salary or dividend, you could say. And do watch my other video on extraction method of funds from a limited company. The link is up below. But yes, they will be taxed again. So there's double taxation there. Rather, if they dispose of the shares as mentioned, then we have the 10% CGT rate potentially available. And if not, 20%. It's still better than the double taxation. Again, each circumstance needs to be looked at because the second scenario is the other benefits. So if you have a company selling shares in a subsidiary, so let's just say we have a company owns 100% shares in the bottom company, the trading company, and the trading company is going to be sold to the purchaser. That top co or hold co, you could call it, or parent company, can potentially dispose of its shares in trade co underneath, subsidiary, tax-free, completely tax-free, provided that the substantial shareholding exemption applies. Now that's a different topic in and of itself. But broadly speaking, the conditions usually do apply. So therefore, the company would be able to dispose of its shares completely tax-free. So the full sales proceeds will be received by the holding company, and then those funds will be available. Again, you need to extract the funds. Okay, so there is taxation at that point. However, there's scope, of course, to keep the funds within the company and do basically diversify into other activities or other ventures as well. For example, property, which is something we see quite a lot. So these are the implications from the vendor side, whereby they sell the shares of a company. So individual shareholders, potential business asset disposal relief, capital gains tax, annual exemption, potentially to have the consideration received over 2 tax years potentially, or deferred consideration. So there's different ways to structure a sale, and that is specialized work that we do for clients. But that's not the point of this video. So Yeah, so as individual shareholders, you have the potential BADR up to the lifetime limit of 1 million, and then you have the annual exemptions, and you can play around with the shareholdings between spouses, for example. Or if a company, then we're looking at SSE. Now, in terms of the purchasing company or the purchaser, they probably would not prefer to purchase the shares. Why? Because effectively they are purchasing a dirty company. When I say dirty company, they are effectively taking on all the history of that company, and there is potential scope to deal with these issues or mitigate them by way of indemnities and insurances. But broadly speaking, the purchaser would prefer to purchase the trade and assets. Now, what needs to be remembered, so we're just having a general discussion. I haven't really structured this video. I'm just going to discuss as and whatever comes up. But we have the purchaser. Now, if they prefer to purchase the shares, there's 0.5% stamp duty on shares that needs to be paid, compared to if they prefer to purchase trade and assets, and depending which assets are within the company, then there's stamp duty, land tax payable. Okay, on the, let's just say there's some commercial property, residential properties, let's just say, for example. So there is that stamp duty versus stamp duty, land tax in purchasing the shares or in purchasing the trade and assets. So effectively, the purchasers can effectively pick and choose what they want to keep or what they want to purchase, and then the liabilities can be left behind with the seller, the vendor. And I think you might start to see why there's that conflict. The seller would prefer to sell the shares, just get rid of the company, but the purchaser would prefer to purchase trade and assets. There's massive clashes there, and that's why negotiations, as I mentioned, need to take place. There are a lot of other implications that need to be looked at. There's so many other things, such as the intangible fixed assets regime that can be looked at, degrouping charges at a certain angle. We did mention the stamp duty, land tax broadly, but these sort of transactions are of course complex. They're not straightforward in any sense, and most of the time we're talking worth millions in terms of the transaction size or the deal value. So care must be taken, advice must always be sought, professional advice must be sought, and in terms of all angles, so due diligence, corporate finance, and of course the taxation as well. So we do work with other firms and advise on the tax affairs, whether we're advising the sellers, the vendors, or the purchasers. So feel free to contact me. My email address is above, omar@aswatax.co.uk. I'm a chartered tax advisor. We as a firm are chartered tax advisors. So yeah, do get in touch. I hope you found this video beneficial. I hope you found it useful, some sort of insight background. Don't forget to like, comment, share, and subscribe to our channel. Thank you for watching as always. Thank you for listening. Bye.